folks, come on back here to the Diagnostic Trading Hour. Glad to have you back here on TFNN.com. And let's see here, checking things out, trying to get some screen share going on. There we go, got that. Put it on up there. You ought to be able to see my screen right now. All right, let's check out where the markets are at. We got the S&P up 12.5. We got the Russell up 7.8. Nadex currently up 37, and the Dow is up 96 points. We'll get on over at copper. Copper is currently down 1%, almost 1.25% on the day. We got gold is up 2.8 points right now. Looking on over at silver. Silver is down about 0.5%. We got natural gas. Looking at our energy sector. Natural gas is flying down 3% on the day. Massive move there in natural gas. Got oil currently down just a few cents right now. But it's definitely had plenty of movement going on with the inventory reports. We'll pull that up and look at it. Checking out corn. Corn is currently flat on the day. We got soybeans down about 11 points right now. And we got pound dollar down 113 pips. So working beautifully off the news trade we talked about yesterday. Worked out really well. We got the euro dollar flat. Worked out well for other trades as well. So we'll go in and we'll walk through those. Checking out the euro pound. Euro pound is currently up 56 pips. It's actually a pretty big move for the euro pound. You don't usually see that kind of movement on it. We got the dollar CAD is currently flat. Dollar franc down 2 pips, and the pound yen up 24 pips on the day, with the euro yen up 29, the Aussie yen up 46, and that's your market midday lunch market wrap right there. Okay, so let's go in. We had a few news trades that we were going over yesterday. Let me go ahead and just open those on up for you, and there we go. Let's talk about them, what we had going on. We had the unemployment and everything. I said, hey, you know what? There's not a lot of moves that we go in for straddles nowadays, but this is one of those that we do dive in and expect to actually get a nice big move on. So what I'd like to do is go through that trade with you and help you understand it, because I saw a couple traders. They sent me some notes, and they did well on the trade. So I got some traders that made some money on the trades. Some did the binary, some did the spread. One of them said, though, they did the binary because they didn't really understand how to choose the spreads for a straddle. And so I want to make sure that you do understand how to choose a spread for a straddle. We don't do a lot of straddles. And also, of course, how to even choose them for the iron condors. But focus, right now mainly just on the straddles, just because that was, one of the, we don't do those that often, and we can, sort of keep it on one main topic. And so a straddle is, when I'm referring to straddles, I'm referring to spreads. When I'm referring to strangles, I'm referring to binaries. The reason is because you have two different strike prices. Okay? So with two different strike prices, that'd be a strangle, because it's like putting your hands around somebody's neck, strangling them, okay? One hand on each side in two different places. Okay, so since it's around it, it's a strangle. So straddle, it's straddling the fence or whatever, like you're right on top of it, okay? And so it's the exact same strike there. And so you have the same floor and ceiling on a straddle. And just to show you visually, let me open up the scanners here, and we'll walk through that a little bit for you, okay? So right up here, if we go in and go over what it is on a strangle here, and somebody was doing a strangle on, say, the pound, then it'd have to be an upper strike and a lower strike. So they'd be going in and choosing like one up here and say one down here, okay? And that would be a strangle. It's two different strikes, like buying at 67.10, selling at 66.80, and you have to make sure your risk is pretty low. You want a combined risk of about $25 or less on those trades, because you want to take profit when it hits the strike. When you look at that, this is on binaries, you have to actually expect it to move that far. So you have to look at what the pricing is and go, can I pull this off for less than about $25? And if I do that, I got to take profit when it hits it, and do I expect it to move far enough in either direction, or whatever our expected move is, for it actually to take place? So if I'm saying do a straddle for 40 ticks, that probably means that we're expecting about a 60 to 80 tick move on a market. And so that would be a possibility for you. But that's not a straddle. That's a strangle. To do a straddle, you're going to go over to the spread scanner, and you'll choose your instrument, such as the pound dollar. Okay, so we'll turn all the other ones off here. And then reset all your filters just to make it really clean. Let's go and let's say when a 1-to-1 risk-reward ratio. And then you go, okay, so I got all those, and now you have all the strikes coming up. And so we can get rid of some stuff. The main thing is, if we're straddling the news, we want to make sure that, say, the straddle actually happens after the news. It expires after the news report is over. But so if we go over here, we'll get this one, and let's see if that's the right one. There we go. Okay, so it expires like in 106 minutes. And then we'll go up here, and we'll look at a buy side that has the same floor as the sell has a ceiling. So we want the ceiling and the floor to line up. So 66.90, we go over here. Where is a 66.90? There it is. Notice again, let me zoom in on this so you really understand what I'm saying when I say floor and ceiling. 66.90, that's the floor of the spread on the bought spread. So when you buy a spread, the floor is below you, the ceiling is above you, okay? And the same thing, when you sell a spread, the floor is below you, the ceiling is above you. Really simple. We want those numbers to match. We want the ceiling and the floor of the two different spreads, so the ceiling of the sold spread to match the floor of the bought spread. So they're both at 66.90. This is how the graph looks. So if we go right over here, look at this. You'll actually see that they come together right there. And to really zoom in on it for you, right here, this is the live market price, that little different shading in the gray. That's the live market price. And this is the market. If the market goes up, if the market goes down. Okay? Well, what happens if the market goes up? Here's your profit and loss. Okay? What happens if the market goes down? Here's your profit and loss. Notice how we make money if the market goes up. We make money if the market goes down. See the P&L, price going up, price going down from where it is right now. So the ceiling of the sold spread, the top of the sold spread, is the exact same as the floor of the bought spread. Okay? So that's a straddle right there. Basically, you have the exact same, that strike, that floor ceiling strike match. Now, obviously, you have a higher ceiling on the bought spread because you bought one with the floor right there. So our ceiling up there is, you make money up to 68.40. That's plenty. That's plenty of distance. It's 150 ticks. Okay, we don't even expect it to move that far. And then you can make money down to 65.40. Again, it's 150 ticks lower. We don't expect it to move that far. That is a straddle. Okay? And then when we look at the risk, look at the risk over here. It has like $8.90 and $7.90. Now understand, I actually calculate in the fees, the 90 cents. Now that's if you're doing a single contract, it goes down. If you're doing more than 10, your fees get cheaper because what happens is it caps at $9 a contract. So if I did 100 of these and I sold 100 of these, then I paid $9 on this one and $9 on this one. Okay, so it'll be like 9 cents instead of 90 cents. So your fees do go down. But I show just based on a single contract. That's what a lot of new traders are trading on. And so basically we got right here combined risk of, approximately $14 to, $16 if you're adding in fees. So $7.90, that is fees included. That's a perfectly balanced straddle. So if we'll just add in the fees, we'll say $16 on the trade. That's our risk on the trade. And so when I say a maximum risk of $40, well, 8 plus 8 is less than 40. Therefore, I can put on a straddle for less than $40 risk. Now, I may give or take a few dollars. Okay, don't go so stringent that, oh, it was 42, so I can't do the trade. You gotta have a little wiggle room in there. I'm basically saying max profit, but yeah, if it's $42, am I going to totally throw the trade out the window? No. Okay. Now, I'm still only going to go for a $40 profit, so I'm only going to try to make 38. So I don't necessarily need to get that 1-to-1 if I go over it, okay? But the main thing is you're looking for trying to find a straddle that expires after the expiration or after the news announcement is released. So let's say if we had a news announcement at 2 o'clock, this expires at 3. That's awesome. Last night, we're okay, get in around somewhere between 11 p.m. and 3 a.m. Make sure you choose a 7 a.m. expiration because the announcement was coming out. a little earlier in the morning. Let's see here. I'll show you that. It's coming out at 4:30. And then we also had like 5:30. We had Governor Carney speaking, the Bank of England inflation report. Well, we got a lot of British news coming out. And based on the historical stats, this is one of the news movements that actually does consistently move the market. And so that's what we're looking for. We want something that is going to consistently move the market for us. And once you've chosen that, then you'll simply buy one. You'll buy this one, and you'll sell this one. And another important point, you'll notice that the risk and reward are balanced. That's because we're right at where the market is. Our floor and ceiling are basically trading right where the market's trading. So that obviously makes that a little bit easier on you as a trader whenever they do line up like that. And a lot of times that's why I'll hop in at 11, because I know that at 11 o'clock, they set the thing like 5-10 minutes before the 11 o'clock starts trading, the 11 p.m. to 7 a.m. So right before it starts trading, they actually set those strikes. The longer I wait, the more that the market can move around, the harder it can be to find a balanced spread like this where you have the balanced risk reward. I still take them when they're not balanced. So that's not like an abnormal thing. I'll still do that. Anyway, so if we go over and we look at the pound dollar, and let me bring that up over here. Bring this up like right here like this. And you might be able to guess where the news came out last night just by looking at this chart here. And so the market's dropping on down. We go out the announcements right here at 4:25, 4:30. So there's like right where the market is. We got it at 68.05. And it just flies down quickly and works out for an excellent profit. Actually keeps trending down into the day. But we'll talk about it more when we get back. Stay right there. All right, folks, we're going back here to the Diagnostic Trading Hour, and we're checking out the pound dollar, going into that, and the movement that happened on it. And we're talking about the straddles, and the straddle play I called out yesterday. And so what I wanted to look at is, we had the market right at like 68.05 or so last night. So we got 68.05, and it drops on down by 7 o'clock. We're getting a low down here of around 66.88. So minus 66.88. It's a 117 pip move. So a solid move. We were happy with 80 pips, and we got way more than that. So, obviously you love it when a plan comes together, right? So a little Murdoch from A-Team there. And, or Hannibal, I guess. But, anyways, looking right over here, we got the buy and the sell side. We put those two together. We have usually about a $40 risk on the trade. And I want to say I even had one trader sent over to me a picture of one of the trades they put on this morning. On that, let me see if I can get that one. And right over here, we'll go in and pull up the specific trade. Right there it is. Okay. So I can go in. He sent this one over. And just wanted to show, one of the, this came from Yogi here. And smaller trade for him. I know he does a lot of big trades, but they're on like 10 contracts on both sides. And he went in and put the trade in and got the 68 by 68. So remember, we were about 68.04, so it's pretty much right on target with it. And let's see. So when he sold this one, 67.81, he had about 19 ticks of risk on that side. He bought this one at 68.24. He had about 24 ticks, so you put those together, you're going to get about $42, $43. So like I said, give or take a few bucks. So he got the trade on, put it in there, and let's see, not sure exactly what price he got out at, but if he held the trade, then he really cleaned up. If he got out at 1-to-1, obviously no problem there. The market definitely moved far enough for that to take place. So hopefully you understand that, a straddle is simply buying the upper spread, selling the lower spread, and your risk reward, if you're using the scanner, is going to look like this. If it goes up, you make money. If it goes down, you make money. That's the exact same floor and ceiling. You'll notice they touch right there, okay? So same floor on the bought spread, same ceiling on the sold spread, and combine the two, risk and make sure it's pretty much, less than the max risk we define. And again, give or take a few bucks. That's all there is to it. And then what you want to do is like, well, what is my take profit? Well, for a 1-to-1, and this is where people get all confused, okay? You got to remember one side's going to lose, okay? Like, I mean, it may come back. I mean, you may make money on both sides, but you're not really counting on that. So how do you handle that? What do you do? Let's say we have $20 risk on one side. We have $20 risk on the other side. So $40 risk. We're expecting one side to lose 20 bucks, right? Because if the market goes down, if we just pull up that same chart on the pound dollar over here, the market were to just go down like it did. Okay, it actually flew up first and ran down really fast. And it flew up about, it got a nice move on up. So depending upon, I guess, where you're at. But it flew up about 60 pips. That's a massive up move right there, actually, off of that. And, 45 pips. Okay. So let's say you have $20 risk on both sides. And let's just say it goes straight down, doesn't come back up afterwards, like this trade right here. Then the $20 on the bot side is going to lose. And you risk $40 on the trade. Okay, so it's really not hard to put together, but to make it really simple, I got 20 up here. I got 20 down here, which means that I'm trying to do what? I'm trying to make, if I want to do a 1-to-1, I'm trying to make at least 40 bucks. Well, since the market went down, I'm going to lose $20 on this side. Okay? But I want to net $40. So I need to make 40 bucks on the one I sold. But I actually, if I make 40 and I lost 20, I only walk away with $20 in my pocket. Okay? So again, if I make $40 on the sold one and I lose $20 in the bought one, then I only walk away with 20 bucks. So I actually need to make 60 on the sold one to cover the 20 lost on the bought one and still walk away with $40. So I need to make 60 bucks. Stay right there. We'll talk more about this when we get back. All right, folks, we'll come on back here to the Diagnostic Trading Hour. So just walking through each piece of this for you step by step. And let's see what we got going on over here. All right, so what I was walking through is wanting to really make sure that you understood the straddle and understood how it worked and where the take profit was, because that's where people get tripped up. And it's not as hard as people make it out to be. So if we have, let's say, a $40 max risk on the trade, we want to make $40. Maybe at a $43 max risk, I'm probably still going to go for $40 if that was the trade plan. Okay? But so you got a $40 risk on the trade, and let's say the upper side had a $20 risk. The lower side has to make 60 bucks to account for the $20 loss on the upper spread losing. So that way you walk away with 40 bucks in your pocket, because you get to keep the 20 from the lower one that you had, but you're going to lose 20 from the upper one. You keep it, meaning not make it, but just get your money back. But you're going to lose the 20 bucks you put up for the upper spread you bought. With that in mind, now I got to make $40 and another 20 to cover the bought spread. So I need to make $60, 60 pips on the trade. Well, where do I make 60 pips at? I got to buy it back 60 pips lower than where I sold the spread. Okay? So, if I was looking over here at this trade example that a trader sent in to me that they did, and they went in and they sold the 6,500 to 6,800 spread at 67.81, and they had about $40 risk on the trade. They want to buy it back $40 lower than where they sold it. So they sold it at 67.81. They want to buy it back at 67.21. So when it came down here and hit 67.21, boom, they're out of the trade. Okay? About 15 minutes after the release came out. That's where they want to be hopping out of the trade. Okay? So they can walk away with $40. Now, if we want to get really specific, like right into this exact trade and go, okay, well, technically they bought the 6,800 to 17.1 for 68.24, so they had $24 of risk there. So we got $24 of risk. So we'll just add it all up. We got $24 of risk on one side. We got $19 risk on the other side because they sold the 65 to 68 for 67.81. All I do is I take 6,800 minus 67.81. That's 19. So that's how I know it's 19 ticks of risk, because you can't lose more when you sell a spread above the ceiling. So if I sell 70.81, go as high as it wants to above 6,800, I won't lose more than 19 ticks. Okay. So on the bought one, if I bought at 68.24, I can't lose lower than the floor when I buy. So 6,800, so 68.24 minus 6,800 is 24 ticks. So I got $24 risk on the bought one. I got $19 risk on the sold one. So again, I take that 19 plus 24. I got $43 total risk on the trade. Well, I need to make, basically, I said I want to make $40 on this trade. So let's just say we're going to go for the flat 40. We're going to keep it simple. But to do that, I got to look at it to have a little bit of imbalance because I had 19 by 24, right? So I need to make $24 plus, we'll say $40. I need to make $64. So to be at a 1-to-1 on the sold side, I'd make $64 to cover the $24 on the bought side. So if I sold for 67.81 minus 64, I need to buy back at 67.17. Now, on the bought side, if the sold side were to lose the $19, then 40 really plus 19. Okay, so 59 pips. So where did I buy it? I bought at 68.24. Add in on here 59 pips, 68.83. So if the market was to go up to 68.83, I hop out. I'll cover my $19 risk on my sold one, and I'll keep $40 in my pocket because I'll make $59 in the trade to cover the 19. So $40 is left out of the $59 I made, and I lost the 19 on the sold. If the market flies down, then I'm going to buy it back. I'm going to buy back the sold one at 67.17 because I'm going to lose the $24 on the bought one, but I'm buying it back basically 64 pips lower. That'll cover the $24 on the bought one and put $40 in my pocket. And so I just need the market to move basically to one of those two price levels. It does shoot up quite a bit. It shoots up to 68.45, and sometimes, I mean, it didn't happen on this one. Sometimes, I mean, it'll literally pop up, it'll hit one, and it'll go down and hit the other. You hit double profit. That is awesome when that happens. Didn't happen here. It just shot straight down. So the bought one lost. The sold one was profitable enough to cover the long, the bought one, and put $40 in your pocket. And that is a straddle. Okay? That's the trade that we were shooting for. And it worked out perfectly. It was exactly what the entire plan was for yesterday and how to do the trade. And market's just been hanging out way down here ever since then. Other things I'll look at, I'll tie in key deviation levels. So we can go over here and we put the deviation levels up for you. And so you can go down and look at, pound dollar, what do we got on the market moving on down. And, we are basically looking to take profit right here around 67, 20 or so. Go, well, is that tied into a level? And 67.40, 67.14. So we're actually getting down to, pretty low, pretty big move. But one deviation itself was at 67.65. So right up here was like one deviation move. And we were expecting a much larger move just because of the way this report comes out. It came out, it moved down. It basically hit our take profit within 15 minutes. And this is a very fast move, like right there. By that point, we'd already hit our take profit. But I'm going to be mindful of those levels. If I see it start slowing down, I may want to take my profit a little bit early. Or if my profit's just on the other side of a deviation level, let's say it's 5 ticks below it, I may go in and take it a few ticks above it because you'll see it over and over again just bounce right off of deviations, and it's just not worth holding it to see what happens. We haven't quite made it to a 3 deviation level today. It was a big move, though. We moved all the way down past 2 deviations on the day. So big move right there on the pound dollar. And let's see, what else do we got? We had a couple other trades as well that I went through, and so we can pull those up real quick and look at them. And step by step over here, pull it up, and we'll look at what we had pound unemployment change. That was the straddle for yesterday. We had a couple be aware events. We had the core retail sales come out this morning, and on that we were looking at the euro dollar. We were looking for the euro dollar to be somewhat flat. Let's see how that worked out in the morning when all was said and done. We were looking at entry at around 8 o'clock, so right here, 64.11. And at 10 o'clock, we went down to, what was our move at 10 o'clock? 63, basically 63.80 for settlement there, 33.80, I'm sorry, 33.80. And from, if we got in right here, 34.08, so about 28 pips. We were expecting to move a 30 pips or less. We basically got about a 30 pip move. That was right near a break-even trade. Probably made a couple bucks on that trade. So nothing fantastic if you were able to get the fill for the quantity. And I said we were willing to stick to that 30 pips on that trade. So I'm glad we did. We can go over and we can also look at we have a couple more trades tonight. We have some earning releases coming out. We got Cisco coming out. So make sure you're aware that that's going to come out at 4:05 today. And right there in the NASDAQ. So CSCO. And let's see here. Tonight we got the yen core machinery orders. We got the Aussie inflation report coming out to be aware of at 9 o'clock. We got the freight PPI, which you can trade this evening. That one's going to be an iron condor. Going to be the opposite of what we talked about today on the straddles. And that's where we're going to go in, and we're going to do an 11 o'clock entry no later than 3 for a 7 a.m. expiration for a $35 minimum. Instead of maximum risk, it's going to be a minimum profit on the trade. And we also have a Euro CPI coming out as well, where you can do basically the same entry. Okay? And then tomorrow morning we'll have the unemployment claims. So looking at an iron condor, watch the spike striker as well off of that. And we'll have the US PPI news coming out. We can do basically the same trade to what we did this morning on retail sales, going for 8 to 10, except for it's really, really a small move. We're only looking for a $20 minimum profit on that trade. And so a lot easier fill there. Then, of course, we'll have natural gas. Don't forget, on natural gas, you need to add to your list to be checking out, looking for spike striker. Now, we can go over to oil. And on oil here, let me pull that up. And we can see we got some nice movements right off of it. And I wanted to see if I could find one other setup. Let me see if I can pull that up for you. And we'll just look at it on oil from earlier today. And, okay. So, on the oil trade from earlier, I had a couple charts that I'd captured. And I wanted to see if I could show them to you. And right over here, it's taking a little longer than I'd want for it to load up. But we had some nice moves. Movement stayed within the expected range. Here we go. So here's one trade from some traders I was talking to earlier. We had a nice short spike striker right there in the money. Over here we had a long spike striker if it was in the money when it fired off, meaning like right here at the lows here for the in the money. Would have worked out well. Again, if it's ever close, you want to hop out on those trades, but it worked out really well. And it's just a matter of making sure you're picking that right strike, because you want that, right there where the low or the high was, because that's where you don't expect it to go back to until after the market's had its time to move around. But looking at the expected move, we had a perfect expected movement on the high to low, right off of the oil inventory. Right as we hit that perfect expected move, it pulled on back up. So it did exactly as we thought it would, and popped on back around there. And then pretty quiet in the hour after, and then we had, again, a perfect expected move, and it pulled on back right in the most recent 1 o'clock hour on oil. So some good moves just on the oil inventory report. I want to cover that with you. And with the oil inventory knocked out, what else do we have left that I want to make sure you have on your trading plan for today, tomorrow? So got that freight PPI, Euro CPI, unemployment claims, PPI, natural gas coming up tomorrow, so same type trade setup as oil. And that's really the main trades for the week. Sort of a quiet week overall. As far as what's in store for us next week, we can hop through on here real quick and just sort of, go through it. Let's see what we got. And if I can hit the right buttons there. There we go. All right, so let's see what we got coming up next week. We got any big, we got U.S. core CPI. That'll be good. Pound CPI. We're going to have facility votes. That's okay. Now, meeting minutes, it's not the same as interest rates, so don't get too excited about it. We'll go in, either the markets were nervous about what they're going to do with those interest rates. Looking at, we got mortgage approvals, retail sales, existing home sales. Lots of reports on Canada, so we have a nice big Canadian trade coming up most likely next Friday. So sort of a quiet news week next week as well. So enjoy the movement, be a little bit less news controlled, but ought to still be plenty of movement for you to take advantage of. Just make sure you know how to take advantage of those swings. Because either you're going to get really smooth trends or, you'll get just nice oscillations right within expected ranges. So one of the two. That will wrap up our news report for next week. I wanted to see if I could pull up, potentially. I'm having a little issue on closing one thing out, but do this. I'm going to close that workspace, and then we'll pull it on back up. And but if you haven't got, I know some of you are sort of, you're curious about this new stuff. You want to learn how to trade this. I've tried in every way possible I can to trade the news for years, and just about gave up on it until I came across Nadex, trading on Nadex. And if you want to learn how to do this, the first step is just go over to Nadex's website, click on TFNN.com, click on the Nadex banner on the right side of the page, and then under trading, click on demo trading account. Once you go there, fill in your username, first name, last name, phone number, and email address. Click apply for demo. Okay? So fill in that information, click apply for demo. You'll get an email instantly from them where you can log into your account and you can start demoing these trades out that I'm talking about. You can start working through them. And then click on open an account for free and you can fund an account. Now you don't have to go, you can fund it with $5,000, $10,000, $1,000, or even just $100. Okay? Fund it with any amount. Place just one trade of any size. Okay, it could be a $3 risk trade on a $100 account. Doesn't matter. And then you can get your demo account extended for a year while you're learning how to do this. Okay? Stay right there. We'll be right back after this break. All right, folks. Welcome on back here to the Diagnostic Trading Hour. So I got a question from a trader asking, so what happens if the market doesn't hit your profit target on the straddle? When do you say it's okay, it's not going to hit it, and get out of the trade? Well, on the nighttime ones, there's not really anything you can do unless you're going to get, up at 4:30 and watch it for 3 hours. Personally, I'm not going to do that. So I put the trade on. I put on my take profits or my stops if I'm doing an iron condor with the stop triggers, and I go to sleep. And either it made money or it didn't the next morning. I've done them enough. I don't mind putting them on and walking away. Okay? You might. I don't know. So for me, I put them out there and let them take care of themselves. And sometimes it doesn't work out. Most of the time, they work out really well. This one, you would have made more money if you didn't manage the trade. It's really easy to overthink these trades. Now, during the day, and it really was a big deal before when I did a lot of straddles, that I had to really focus on this, because I used to try to straddle everything under the sun. If it had like red on Forex Factory, man, I was straddling it. And that was obviously me learning the process of doing it correctly. But, over time I learned what should I straddle and what should I condor. And it doesn't mean I'm always right, of course, but I put the probabilities, the stats in my favor. And the majority of the time we are spot on. If you've watched the show for any length of time, you know that I call them spot on time after time after time. And that's just it's not magic, it's just going through and doing my research, okay? So it's just a lot of research. And so I don't have to call it before, because in the straddle, the really tough part is it goes up, it doesn't go far enough, doesn't hit your take profit, and turns around, and you can end up losing on the trade. Now, that's why I don't like using binaries for strangles, because if you don't hit the take profit, it's a total loss. okay, on a binary strangle. Because, I mean, if it expires out of the money, you lose everything. On a straddle, if it went up, to say 20 pips and you bought, on the two sides, well, I mean, you got $20 back out of your $40 you put up. Doesn't sound like a big deal, but if you put up 400 or 4,000, it starts adding up. If it moves up just 40 pips, you didn't make anything, and let's say it expires like right at 40 pips there, then you broke even on the trade. If it was at 30, you lost 10. If it went up to 50, didn't quite head up to 80, you made 10 on the trade. So it's a lot easier to lose less than max. I mean, you have to come right back to the square center for you to lose max, okay? So rarely are you ever going to lose the maximum risk on the trade when doing a spread straddle on Nadex. And so that's why I like the straddles, the spread straddles over the binary strangles, because you can manage your risk a lot better. What I found was that was really difficult to take that trade, take that profit off before it came back. And as I got better and better at the iron condors, you'll notice whenever you look at my news plans, when I'm going through it, you'll hear iron condor, iron condor, iron condor. Oh, here's a straddle. Iron condor, iron condor, iron condor. Oh, here's a straddle. It's like the straddle is the rarity for the week. There may be one or two in a week. Sometimes there's none, but there'll be 4, 5, 10 iron condors that we're doing in a week. And that's because I found that often if I didn't hit that take profit and then it did come back and I did lose, and it happened a lot. And so I realized if I just started doing the other side of the trade, started being the guy that was, hey, you want to buy a straddle? I'll sell it to you, okay? And now it goes up and it comes back in, and most of those are a lot flatter than one would assume that they'd be, and we're able to be profitable on those iron condors. That's why it's so important. And the straddles sound so amazing, and they're so much easier, and you just buy it, and it's $40 risk, and people are gravitated towards them, but you don't want to follow the herd, right? And a lot of times figuring out what's easier and then selling it to the people who want the easier trade is often the better trade for you, the premium collector versus the premium payer. But when it's big moves, you definitely want those straddles, and that's why we have those as well. They're just not near as often as you'd think. All right, y'all have a great day, and I'll see you tomorrow right here on the Diagnostic Trading Hour.